Hello, hello, hello. Welcome to Now Stock Trades. In this video, we're going to go ahead and talk about super microcomputer. For folks that don't know this, that are not on our stock terminal, we went ahead actually and called this stock out. This is one of our stock lists. You can see back on December 20th, we went ahead and called out SMCI at a price added of $301.38. Yes, you heard that right. It's currently trading at $1,000, more than $1,000, with a 233% gain. So congratulations for all the folks that were able to take advantage of this. And if you don't recall back in our semiconductor video, we briefly touched upon these particular type of stocks that are in the AI space, that are in the computing space. And we made this video back in 2022, and stocks like this were trading around $45, $50. And as you can see, just between that, it's pretty much 21x, which is a 20 bagger just right there, right? So what we're going to do in this video is, for folks that are just tuning in, we're going to go over one of our stock picks that we pretty much basically picked out on December 20th, and we added it on. And you can, for folks that are on our stock terminal, you can basically see when we add it on, and it's, the proof is in the pudding, right? And it's all documented. But overall, if you were to have doubled down when we added this to its low from the year, you would have been up 10x, if that's correct, percent from year low. And now it's up 233%, right? So from when we added it. So overall, ladies and gentlemen, this is a very beautiful move. It's pretty much what any person who owns a company would like to see in their portfolio. And overall, the question of the matter is, how can this be replicated? Or better yet, how can a investor or a student of the stock market learn how to pick stocks like this? Why did I put this in my watch list? What did I see that surprised me and that gave me confidence in the company? Well, if you look at this screenshot here, it is the 10-year financial history of the SMCI super micro computing company here. And we're gonna go over this right now, but you know how when I tell you guys, I usually take 5% of the free cash flow. So if you go here at 7,123, which is just these numbers are in millions, it's $7.1 billion. So if we were to take 5% of that, and people always say, why do you take 5%? You get a free cash flow of 356. But if you go down here, they have a free cash flow of 627, which should show you that that the 5% is very conservative for this case. But overall, if you were to have looked at the end of the fiscal year of 2023, and you typed this into the intrinsic value calculation, and if you were to type in the 2014 net income and the 2023 net income, and added the free cash flow of $627 million, and then divided by the number of outstanding shares, you get a recession level of 330 and a base of 697, a bear of 697, a base of 965, and a bull of 1,426. So when we added this on to our stock list, it was trading under the recession level, which was why I was very confident in the company. The reason why it was trading in the recession level, well, because, there were years where it became negative free cash flow, then positive free cash flow. But again, this is, I would say, a distraction, because I looked at the overall revenue and I saw the revenue was increasing. And then I went back to the bottom line, the net income, and the net income literally went from 54 to 640. In fact, let's go ahead and put 640 instead of the 732 we put here. In fact, let's just do that, 640 here. You get $1,244, right? So you can see that the calculation didn't even change. That it was undervalued. But I'm just telling you, if you were to put the numbers in, accurately, you could see that the company was undervalued, which is why when I say that we have the best intrinsic value calculation on the market, I mean that, right? Because it's able to capture opportunities like this. Now, granted, you have to input it manually, but you can see how inputting it manually gives you more power. In fact, that's the most accurate one than having some automatic one, which is what we do. We have that one just for positive free cash flow companies. But this is the power of what we created here. Again, I've been doing this for over 10 years. So, I picked up a few things along the journey that I would like to share with all of you. So I saw the gross margins increasing, doing really well just recently, just increasing by 3%, which is great. I have never seen it in around 18%. The operating income has been increasing rapidly. And again, you can graph this on our brain machine. So for folks that are visually, actually, you know what? Let's see if we can go ahead and do that. You know what? Let me give me a moment here. Let me see if we can just graph this live. From my understanding, we have to graph it a couple of times for it to execute, given the limitations of Discord here. But we integrated our stock terminal here, so it doesn't, so we can make sure this is affordable for folks, because it's expensive to have our own terminal. So might as well just build it on the beautiful Discord here to make it cheaper for folks. So let's go to master analysis here, and let's go to the graph, and let's type in SMCI. Okay. So if we go ahead and do that and we fetch this data, give it a couple seconds. I'm going to take a sip of my coffee here. Oh, let me go ahead and make sure. Maybe I put it undercase here. One moment here. So it says it's processing. So as that processes here, let me just clear up a couple of windows here, and then we wait for this thing to load. So it's graphing it in real time. That's why it takes time here. But as this goes, continues the process. So give it there it is. Okay, so this is SMCI, but in graphical terms. So I can graph this in my head. It's fairly easy, but you can see overall the revenue's been going up. The gross profit ratio has been going up. Operating income has been going up. Earnings per share has just increased drastically. Net income has been going up. They don't have a dividend, so they don't have a payout ratio. Overall, this is a little misleading. Shares are not been increasing. It goes from 43 to 51. Again, that's not a lot, because if you were to look at it here, this is not a lot of share dilution. And this is more for probably stock-based compensation, maybe if you were to look at it deeper. If you go to book value per share, it's been going up, which is good for the company. Operating free cash flow is doing really well. Capital expenditures are going down, which means that they're becoming more efficient. Free cash flow is going up. Free cash flow per share, of course, the composition of free cash flow, working capital, ROA, ROE, current ratio, quick ratio, and then interest coverage, debt, et cetera, especially with your PEs, PBs, and PSs. But as you can see here, folks, when I look at something, excuse my dogs here in the background. I don't know if you guys can hear them. But as you can see here, folks, this is what I was looking at when I saw this company and I added it onto my, stock list here. When you look at companies that are increasing in revenue, net income is going well, earnings per share is growing, operating income is doing really well. You get the general gist of things. And if you look at when we added this stock, we added it near the recession case. We added it at $300. The market at the time, which was in December 30 of 2023, it was starting to essentially where's the stock here? Let's go 6 months. So, it was starting to rally a little bit. We caught it right before that rally, but the market was slowly going up. We caught it right around here at 302, and the market was kind of going up a little bit. But then all of a sudden, once we got the FOMC meeting, they realized we're going to be cutting interest rates this year. Doesn't care how much it's going to cut. Then we started, going up, and we went from $300 to $1,000. So you can see how valuable the intrinsic value calculation is. And, who knows, there could be some more gas in the tank, which is, I assume these types of movements are institutional investors. But anywho, this was a good, successful run. My recommendation for folks that are in our mastering and in our stock terminal, especially our mastering, have at it. Look at our stock lists and do an intrinsic value on them to see. There's some probably that have not maybe found their potential yet, and you might be able to find some gems here, right? So this was a great maneuver. I mean, within literally 2 months, you're able to essentially 2.3x your money. Most folks, need, the rule of, was it 27 or whatever? They need around 30 years, 20, was it 15 to 20 years to double their money. When we did it here in 2 months. So it shows you where, when you come at the right time, and you look for undervalued companies trading at just very great price, but they're miscalculated, and that they can be worth more, and you just take you go in, take a swing, and you get the prize. So overall, great success. This is exactly what I like to see. I mean, I would classify this I would classify this as an erection. This is you think that's the erection, but then you realize that's just setting itself up for the mega erection, and who knows, it could continue going up. So all right, folks, and the next one I'm looking at is AMD. So that's another one I'm looking at if they get into the computing space to fight with Nvidia. So and if you look at our daily to 2 to 3 day analysis that we give out in the stock terminal, we talked about how the CEOs are actually cousins. So that's pretty interesting. All right, folks, if you haven't done so, hit that like button, subscribe. And yeah, we try to keep it data driven here. And if you like what you see, definitely, stick around. All right, folks, I'll see you in the next one.